Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and/or financial topics. So let's dive in there, take a look, see what's going on today. If you want to follow me, it's @Finance. If you want to join our community, findingvalue.com, where I dive deeper into all these areas, looking for investment opportunities and sharing those opportunities with everyone in the community. We do have a midweek update that I release going over individual companies and potential investment um, entry points. That's basically where I go over all my entry points for individual companies are in those midweek updates. So that's just released today. And if you're interested, definitely check it out and sign up using that special coupon code for either the monthly or yearly membership. The yearly membership, you get a bigger discount. So Tim Hack, he says silver total breakout. The most important retest in 45 years has just been confirmed with a new high. This is a really big deal for mining stocks. There will be a lot of capital flowing into the sector in the coming weeks and months. I'll be sharing the best trade setups with you every day on Slice. Get your first month for $1 with Tim One. Yeah, so I do something very similar. I think he's right. And what you want to chart, and he's got this silver thing here, and he's not really, he says a 45-year breakout. You can't really see the breakout here. So what it is this is the 45-year breakout. It's this guy there. And we're just starting to break out of this thing. This is a huge opportunity. Another thing that you can do is you do this divided by the United States Consumer Price Index. If you divide it by that, that also is a way. And if we break through, I've got that there. I probably drew it on a non-logarithmic there. That's non-log there. So if we go log, this is a ratio chart though. If we start to break through some of there's a big resistance going across, I'd say about here. There's good resistance in this general area right through here that we're starting to break through. If we see a large outperformance of silver divided by this, and we start to move on up, which we have been, that's generally where you see a big move in the mining companies, is when silver and gold or whatever mining company is mining, when it starts to outperform inflation, that's when they roll. So we had a big move off the bottom here. We had a kind of a consolidation here, and then we're going to move on up. So yeah, this looks really good for silver to outperform inflation, which is going to be really good for the mining companies. And again, here's SIL. This is a ETF of the larger companies there. You can see the breakout. So we are seeing strong moves in the miners. And this will probably go even more so to the upside as silver breaks away from that big 45-year cup and handle pattern. So he's exactly right. Michael Green, it's different this time, says Michael Green. This is the uh, leading economic indicators, X stock prices negative year over year, consecutive months. But I will say this. All right, here's my opinion. If I were to look at the data, they usually declare recessions as this goes up. In my opinion, we've had a recession and it's already behind us, perhaps. It's already behind us, perhaps. And they're just playing with numbers, printing a bunch of money to hide it. It's all nominal um, movements going up. Most likely, a recession is probably behind us. Why do I say behind us? Is it like I have some crystal ball? No, all the charts are bottoming. Steel bottoming, copper broke out. That's why. So when people say it's different this time, it's already behind us, Michael. It's already behind us. You're wrong. You're slow. You're not using the right data. This is not leading economic indicators. What matters is how people are positioning in the market. That's what matters. Now, could we get a slowdown and And could it extend longer? Maybe, but that's not what I'm seeing in some of the charts. Yes, it could still be hanging around, but we're seeing a lot of stuff break to the upside. It feels to me, and there could still be some leading economic indicators that are pointing negative in the short term, but the markets are positioning for this to turn. So maybe these economic indicators will still go down in the near future, but the markets have turned already. And perhaps we start to see these indicators turn lower here, turn around later half of 25, early 26. Perhaps that's the case. But most of these, you can see the recession started when this was already kind of like in the beginning of these. So yeah, the recession was probably already here somewhere. And that's why you're seeing gold go up and silver go up. They all go up during these times too. So I just think that they're lying. That's all. I think that it's not in the data. They're fudging the numbers. Meet Faber says, "Can I post something without everyone getting mad? To put your current valuation extreme into perspective, this is the S&P 500. The chart below shows our estimate of 12-year S&P 500 total returns over and above Treasury yields. This is the most reliable estimate of the equity risk premium that we have examined or developed and is better correlated with actual subsequent outcomes than the Fed model. S&P 500 operating earnings yield, the Treasury yield, the excess CAPE yield of Shiller, Black, and Yurav, and annual estimates produced by Aswath Duran, all whose work I admire, even when I might disagree. So where are we located in this dot plot? Oh, we're all the way down there. We're at minus 11%. We are so overvalued that we're off the chart in the S&P 500. So your estimated 12-year S&P 500 total return in excess of Treasury bonds is minus 11%. Now, there's two ways that you can look at this. You could say, oh my God, what are we doing? This is so overvalued that this is preposterous, right? No one should be buying it. Or you could look at it and say, look, this data point is so far out from normal that something in the market has changed. There is something different. We are so outside of valuation metrics that something is going on. I don't know what that something is. I know you guys are probably sitting back, Andy, well, what is it? What's your opinions on this? I don't know, guys. Something is outside of these standard deviations here. The data, I mean, it's way out, guys. We're like off the chart over here. And all of this is up here. So does the market think we're going to have like hyperinflation or something? I don't know. Don't know. But something's definitely up. I can tell you that. Something is definitely up. Z4 Energy. So Jeff Miller on the Halliburton second quarter 25 call today. We will clearly stack some fleets. Activity is below maintenance level. It says clearly oil prices are too low to support a healthy U.S. oil market. You have a duty to communicate this to your boss. Guys, it is what it is. If something's going down where we can't maintain production in America, then production must fall. If oil prices are too low. This is another thing that this is what confuses me in this market. We've got this outside data point that's off the chart. And then at the same time, we've got off the chart oil, I'll call it effery going on. They're messing with it, I think. And we're sitting here with low inventory levels, and we've got prices that are way below what the inventory levels are. But yet, we can't even maintain production. Like, it's going to start to fall here probably drastically. So just seems weird. Just seems weird to me. Some of these data points, and you start to look, it's like outside of two standard deviations. The oil price in relationship to inventory levels are outside of 2 standard deviations. It's like, okay, we're stacking these things up here. What's going on? Investment wisdom, Stanley Druckenmiller. If you're early on your career and they give you a chance between a great mentor or higher pay, take the mentor every time. It's not even close. Yeah, that's learning whatever you want to do as quickly as possible, and a mentor gets you there quicker. I like to think that I'm filling that role for people who are part of the website. I feel like I'm, somewhat mentoring people. Now, it doesn't mean that I get everything right, but it does mean that I think my strategies and approach work very well. I do think that, and I've had years of refining it, and I'm still refining my approach. I'm still getting better, in my opinion. So, but yeah, find a great mentor if you want to get better at something. Makes sense. Here's Naval. He says, we waste our time with short term thinking and busy work. Warren Buffett spends a year deciding and a day acting. That act lasts decades. This is what bothered me when I worked. When I worked, everyone was so worried about stuff that just does not matter. And it was the constant does not matter crap that just got me irritated. So I ran, I'll just say I ran an entire group basically running a manufacturing facility. That's all. So I did the operation side. Other people, I'd report up to managers who would run other things. And some of these guys, they would just worry nonstop about short-term thinking and just busy work and meetings. And you look at the output from the meetings, and it was like nothing from any of them. It's just a bunch of waste of time. Now, in my opinion, if you can do this, the least amount of communication is the best. And some people will say, well, no, 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 no. You want to communicate as much as you can. No, you don't. You want to set up a system where you don't need to communicate anything. It runs by itself. And same with your investing. You don't want to have to look at something nonstop. You don't have to be thinking like you have to take action. Most of it is a waste of time, and it's just going to reduce your returns. What you want to do is you want to size up the big moves. You want to put all the upfront work in researching your companies, and then you know when to pull the trigger. You're not trying to figure out at the time you're going to pull the trigger. Let's say, for instance, as an example, you go and you say, okay, sometime in the future, copper is going to be a good opportunity. So then you go look at all the companies, you write down the companies, create a watch list where you can watch those companies. And then when copper is the great opportunity that it is, you know the companies that are good, you can pull the trigger, bam, 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 done. What I was frustrated with, it's the mindset that you wait for copper to get good, then you start researching the companies. That's not how I work. I want to be laid out. These are the top three. I'm going to start firing off when these opportunities come. Now, you're going to miss some. I get it. You're not going to be perfect. You're not going to see every single copper company in the world, and maybe you didn't look into all of them. So maybe you missed one or two, or maybe a junior pops up that you want exposure to, something like that, maybe, where you might not get everything. But the way that I look at things is like I've been following these companies. If it gets to a bottom, I can fire away and I know what to get. Instead of, oh, this is a good opportunity, let me go research a whole bunch of things. Now, you can still go back and look and make sure that you've dotted every I and crossed every T, and maybe you are trying to find that last one or two. But I like to be somewhat prepared, or if something were to become a pullback or something, you know the good companies. The biggest US grid has no spare supply for new data centers, meaning project developers will need to build their own power plants, according to the system's independent watchdog for Bloomberg. That's how much power is coming. Guys, energy, electricity specifically, is such a great opportunity to invest. There's all these materials that we need. And I like investing in the materials. I don't like the companies that are necessarily building it, because then there are competitive advantages with certain things when you build things. If you're just doing raw materials and you know the raw materials are going to go way up, and if there's going to be a shortage out in the future, even better, because prices are going to go way up. And we can see that in the charts, like silver and copper and other ones. This is Chinese iron ore inventories. They're down sharply this year and are still falling despite a recent spike in imports. HRC production consumption are making new highs and offsetting rebar weakness, supporting healthy steel margins. Bullish setups for Cape-sized dry bulk and iron ore prices. We're coming on down, and we can see that in the charts. We can see this all in the charts there. Total iron ore import volumes are up, but inventories are still dropping like a rock. Dropping like a rock? Yeah, you got it. So Chinese steel inventory is kind of on the lower end. Chinese steel mill profitability inching up. Chinese steel mill profitability, not too bad. It's been inching up in 2025, higher than previous years. Chinese steel mill profitability, hot rolled coil, it's up more towards the highs there of all the other previous, 3-4 years. Consumption, kind of flat. Chinese steel consumption there, that's up for hot rolled coil. Rebar is kind of down a little bit. Rebar down, and then hot rolled coil is up quite a bit. Looking good. A couple of quotes here. Look down, not up. When making your initial investment decision, if you don't lose money, most of the remaining alternatives are good ones. Basically, buy it when it's low. Manish says return of capital is more important than return on capital. So it's not about the possibility of a return. It's about making sure that it's a good probability that the trade will work out. Freight futures AM update. Look at Capesize. Dry bulk is way up 5%. Panamax up 2. Tankers VLCC is down 1, and Suezmax is flat. Here's Jeff. He says small caps are 20.5% cheaper than large caps on a price to earnings ratio. The years that witnessed these discounts, now keep in mind these years: 1973, 1976, 1998, 2001, and 2020, the bottom of commodity bull markets. Even investors who were early in 73 and 98 would have then witnessed two legendary small cap cycles, 74 to 81 and 99 to 2018. Those small caps looking absolutely great here for a big move. Now, this is a shoulder head shoulder. That's an inverted shoulder head shoulder here on the right-hand side, right there. This one's a bottom. It's not really a shoulder. That's a double bottom there. And this one's an inverted shoulder head shoulder. It's a shoulder, a head, a shoulder, and then we rip higher. I'm seeing these patterns in a lot of the companies that we are looking at and buying. We also have squeezes into double bottoms. So this would just squeeze into a double bottom here. We have that pattern as well. This could also be a shoulder head shoulder with a line going across here. So this looks really good. And what's good is this bottom and turns during commodity bull markets. Value outperforms. And we know how overvalued S&P is and some of these other ones. So this looks very, very good. Our marks, waiting for the bottom is folly. What then should be the investor's criteria? The answer is simple. If something's cheap, based on the relationship between price and intrinsic value, you should buy. And if it cheapens further, you should buy more, says Howard Marks. Now, obviously, he's not a technical analysis guy, but maybe he uses it. But if something's really cheap, you shouldn't wait. You should maybe start scaling into it. And if it were to get cheaper, you scale more into it. That's his opinion, and I agree with it. I think Howard Marks is right here, and I think this is a good strategy because you never know the exact bottom. And if the bottom's behind you and you don't know the exact bottom, well, what do? You're gonna just not take a position if it runs away on you? What if it's a really good opportunity? You're gonna chase? You're gonna do FOMO? It's tough. That's what he means by basically develop a strategy. If it's cheap, go buy it. If it gets cheaper, go buy some more. Brady says silver's breaking out on a yearly time frame from a 45-year bullish pattern, and Silver Miners ETF SILJ here has broken out of a 4-year bullish pattern. Life-changing gains are hard to accomplish. This both because the best market opportunities for it are few and because it takes everything you have got to do so. When a bull resumes, it is vital to change mindset. One cannot play a bull with a bearish mindset. If you doubt the bull, you will not be able to change mindset. You have to believe in the bull, or you'll end up being a victim of the wall of worry, i.e., your own emotions. Most need help with this. If you cannot grasp the new market environment, you will be hardwired to sell as soon as you have a little profit, since you will expect the sideways, down, and big drops from the bear market to continue. And if you sell too soon, you will have messed up the great entry and opportunity. If you are able to pull the trigger at the very lows, that is, which most cannot do either. So it's hard to get these lows. We grab, guys. We nailed some of these silver, platinum group metal miners. We nailed the bottom. We did a very good job. People were sharing their returns, their year-to-date returns of their portfolio on the Discord, as someone had asked, and I asked, "Wow, is that what most people are getting?" Their year-to-date returns are 45, between 40 and 50% year-to-date returns of this year alone. It depends. I don't tell people what to buy. I don't tell them how to allocate, but I do tell what I do and how I allocate. Their returns are matching very similar to mine. I've got multiple portfolios. I haven't aggregated it all up, but I would be very similar to those. Plus, the physical metals are up quite a bit too, which I have a large stake in. I think year to date, silver is doing very well, and so is platinum, which is a big allocation. So a lot of people are in that 40 to 60% year to date range, depending on their allocation of what they did. And each person's different. I can't tell anybody what to do. Your allocation must fit what you think that you have conviction in and that you want exposure for. But some of these are SILJ. Some of them are we bought really, really low for these speculative companies. We bought some producers, and there are still a couple that are lagging behind that I think are really good opportunities that I cover in those midweek updates. But that's all I've got for today. That's where we're going to end it. So give me a thumb up for the content, subscribe to the channel, subscribe to the website if you'd like, and we'll catch you next time. This is Finding Value.